And welcome back to Switzer. It could be argued that many aspirational Australians never hanker for the prospect of being a pensioner. These sorts of people want to be financially independent, but this could be a wealth hazard in itself. To tell us why being a pensioner could be financially cool, I'm joined by the coolest guy of all, Tony Negline of Financial and Technical Solutions. He writes in The Australian. He's a star writer in the Switzer Super Report as well. How are you, Tony?
I'm very well. You're the first
No one ever calls you cool, do they?
Not even my children.
No, definitely not your children. They know you.
That's right.
But I've got to say to my colleague Steve Price at 2GB, I've been teasing him that he really should be a pensioner. He's over 55, he's got a self-managed super fund, and tell us the reason why he should be a pensioner.
Well, there's two angles to it. One, you reduce the amount of tax you pay in your fund, and secondly, you also potentially reduce the amount of tax you pay on an income tax basis. And thirdly, and I suppose best of all, it might actually help you improve your super account balance before you formally retire.
Exactly. So we should explain to people, we're talking about a transition to retirement pension.
That's right.
All right. And what's the critical birth date? Because if you're over 55 now, you can do a transition to retirement pension. So what's the critical date that people have to remember? It's like 1960 something.
If you were born after 1960, the critical age is 56, and all the way up, and it increases by ages. So if you're born after 64, July 64, the critical age is age 60. So for most people right now, it's 55.
So the lucky people over 55 now, or 55 or they'll be 56 now, have a chance to do this transition to retirement pension. But you don't have to retire. You can do both at the same time, can't you?
You can technically be working full time. You could be working anywhere from 1 hour a week to 40, 50, 60, 70 hours a week, and anywhere in between.
Okay, and when people say to me, well, and Steve in particular said, well, I don't really call it a pension. I said, well, the reality is, there's nothing wrong with that anyway, but the important thing I say to him is, well, if you've got, say, for simple figures, $1 million in your super, and you listen to great programs like this, and you did 20% on your super fund last year, well, that's $200,000 on $1 million, right? And you tax at 15%. That's $30,000.
So there's 30 grand on the table.
30 grand on the table, you wouldn't have to pay tax if you just made a decision, hey, I'm going to tick the box to be transitioned to retirement.
Well, it's not only in the super fund itself. So effectively what you're doing is that you're actually just moving the deck chairs around of your wealth and your income sources in order to minimise tax. And grow your wealth.
And it's one of those government-approved rorts like the FPT and cars.
Well, I wouldn't necessarily call it.
No, I don't think so either.
I wouldn't call it a rort. Or it's an opportunity.
It's a great opportunity.
It is a great opportunity.
People who aren't doing it or who are under 56 might say it sounds like a rort to me.
I have met very few people throughout my working life, my more than quarter of a century of working life, who are more than happy to pay more tax.
No.
The vast majority...
They should be incarcerated if they think paying tax is a great idea.
Well, they probably vote for a certain political party.
Hey, come on.
So they probably... but the vast majority of people are happy to structure their affairs so that they can pay less tax and grow their own personal wealth and keep some of it themselves. As you know, it's hard enough to earn it. It's easy enough to spend it. Why have more cost in your financial arrangements that you don't have to have?
Exactly.
Really.
So the example stands then. Your money is currently, until you opt for the transition to retirement, is currently in the accumulation mode, and that's when you pay 15%.
That's right.
The day you tick the box, that money, just say it's $1 million, transfers to the pension mode. It then have zero tax. The new money you put in is in accumulation mode, and that's
still taxed at 15. So depending on your circumstances, that might be employer contributions, taxed at 15. Might be personal contributions, after tax money. You might even be, depending on your circumstances, you might even be allowed to claim your personal contributions as a tax deduction. You've still got things like excess contributions and all that sort of stuff to think about. So all those rules are still in play. If you're a very high income earner, your concessional contributions might be taxed at 30%. So there's a whole bunch of rules that you've got to think about. But overall, for most people, you can generally structure your affairs so that you will end up in front from a total tax perspective.
And also there is a minimum amount you have to take out, and there's a maximum as well in transition.
For transition, that's right. So this financial year, for people who are under 65, the minimum is 4% of your account balance. There's pro-ratering in the first year you do it, there's a maximum of 10% of your initial account balance.
So some people who actually might need a bit of cash flow, if they had $100,000 million in their super, they actually could get $100,000 out in 1 year, couldn't they?
Correct.
If they needed that cash flow.
If they needed that cash flow, that's right.
Yeah.
So you obviously need to do those mathematical calculations before you start the pension. So you need to know where you sit as far as your minimum and maximums are concerned, and then you've got to make sure that your fund actually pays you those amounts.
Okay. Also, you could do this, Tony, as well, couldn't you? Even if you didn't need it, you could draw $100,000 out and recontribute it, and that means that that money is now untaxed money. Is that possible?
Yes, it is, and there are a number of people who do that. So they use the contribution rule. So they take the money out. They use they take out, say, employer-funded money, taxable money. They then recontribute it back as after-tax money, so it then becomes tax-free. Now that's not necessarily important for them. It's important for their dependents, their non-dependent adult children, when they finally pass away.
So the more you can convert potentially taxable money, and that's the money that's come in through your boss or through salary sacrifice and things like that, the more you can take that, recontribute and make it untaxable. It's great for when you eventually kick and the kids get the money without a tax impost.
That's right, because anything that is tax-free component is always going to come out tax-free. Anything that is taxable component, for example, employer contributions plus earnings, is going to be taxed in the hands of non-dependent children at 16.5%. So by using this system, you can flick it around so that it becomes tax-free.
I should be saying to anyone who's watching this interesting debate on superannuation, we know superannuation is very interesting, particularly you and I do.
It's a cool subject.
But it kind of underlines the value of going to a financial planner. Everyone thinks financial planners are there to make heaps of money on the stock market, but actually knowing these rules can be really beneficial for people, can't they?
These structuring rules are actually highly important, and this really should be bread and butter of any financial planner. So there's obviously lots of different variations that will apply to different taxpayers, and a financial planner should be going through all of those different variations to work out which one is the best based on your circumstances.
Okay, let's also look at the situation now, how we use transition to retirement pensions to actually turbocharge your super. So explain how that could happen.
Okay, so what you do is that if you're over 60, the pension that you receive out of the transition to retirement pension actually comes into your hands tax-free. So then what you do is you then use some of your income that you earn from your employment or business activities to contribute that money into superannuation. You get, obviously there are tax breaks and so on and so forth, and depending on how much you contribute, there are obviously tax benefits there. So you've got tax-free money coming into your hands. You've got, which is a tax saving in itself. You've then got a more efficient way of increasing your wealth back into superannuation using your, as I said, your employment income or business income. So therefore, there are tax savings. So that's how you get. Plus, not only that, not to confuse things, but the earnings on the pension assets are tax-free. So therefore, you're ticking all the boxes. That's how you get. That's the
turbocharging of your super.
That's how you turbocharge.
And I think we should make this point that if you're taking your money out of your pension, let's say you take $25,000 out of your pension, which is out of your super fund, which is tax-free, that gives you the scope to actually contribute the maximum concessionally, namely $25,000 if you're under 60. If you're 60 or over now, it's $35,000.
That's right.
So, and the more you can get in through that method, the quicker you can get that superannuation up.
That's right. And then there's another kicker on top of this.
Love the kickers. Tell us about the kickers.
Now, the way that the situation has all changed now. So not only do you have 35 grand, but also excess contributions are now taxed at a person's marginal rate. So if you've got no income, your excess contributions can actually be taxed at a lower rate.
Which is nothing up to 18,000.
That's right. So you can find yourself. So in other words, where everyone last year was trying to keep their contributions sort of roughly 25 grand, not much more than that.
Sticking to the cap.
Sticking to the cap.
But the penalty was tough.
Now you've got to. So anyone who has a transition to retirement pension now, they need to go back and reassess things and work out whether or not they should start making excess contributions.
It's because once upon a time you could have been charged up to what, 92%.
That's right. So
the worst case scenario.
That's right. So it's obviously on a case-by-case basis. You need to be very careful because you can easily go into a very heavy tax situation. But for those who can structure their affairs, it is back to square. You really do need to reassess.
I guess there's one last question we should ask you about. When you are taking the money out between the ages of 56 or 55
and 60, there's a rebate. The 15% tax off. Well, it's called tax off.
Yeah. So the money that you're drawing out of your super fund, that isn't tax-free, is it?
No, it's marginal rate, less than 15% rebate.
So it's your marginal rate. So if you're on the 45 plus the Medicare levy, you take 15 off, so it puts you at 30.
Correct.
Okay.
Correct.
And so that's the kind of figuring you should do to work out what kind of cash flow you need to have a good working life, but at the same time building up that superannuation.
Yeah, correct. So what you need to do is you need to strip your own personal tax affairs out and work out how much tax you're paying, both at super contribution level and also personal level.
Yeah.
And then you need to look at the super fund and say, okay, well, how much tax would I be paying at a 15% basis, and how much am I saving at a nil tax basis, and line all the ducks up.
Yeah.
Or line all the tax and add all the tax amounts up.
All right, mate. Thanks for coming on the program. I think people are working out why we get you to write the Switzer Super Report. You make the stuff understandable. Well done, mate.
Thank you.
If you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you have a self-managed super fund, you want to get expert advice from guys like him, switzersuperreport.com.au website. And if you've got any questions for me or ones you'd like me to put to an expert, email me switzer@skynews.com.au. I'm Peter Switzer. Thanks for watching, and I'll see you tomorrow night.